Good morning, children. So, in the previous video, the other day, we have started this chapter accounting ratios and we have discussed the two categories or the classification of ratios, that is liquidity ratios and solvency ratios. So, two categories were covered. Today, we are going to see the remaining two categories of accounting ratios, for which the third category is activity ratios. These are also known as turnover ratios or performance ratios. So, what are these activity ratios? Activity ratios measures how well the resources have been used by the business enterprise. These ratios measure effectiveness with which the enterprise uses its available resources, and the expression of these activity ratios are in number of times. Unlike solvency ratios and liquidity ratios, which are expressed in pure form, these activity ratios are expressed in number of times. Now, the most commonly used activity ratios are: number one, inventory turnover ratio; number two, trade receivables turnover ratio; number three, trade payable turnover ratio; and number four, working capital turnover ratio. So these are the four important types of activity ratios, and we are going to see today the first type of activity ratio known as inventory turnover ratio. This ratio establishes relationship between cost of revenue from operations, that is cost of goods sold, and average inventory carried during that period. It aims to determine the efficiency with which inventory is used. So, children, I hope you know the meaning of this word inventory. Inventory means stock. So, every company which prepares or manufactures their product, they have to see the position of their inventory, and this is one of the ratio which helps to measure the to measure the efficiency with which the inventory is used by the business. The formula says inventory turnover ratio is equal to cost of revenue from operations, that is cost of goods sold, divided by average inventory. In previous class, in class 11th, we have already seen the formula for cost of goods sold, and the same here is known as cost of revenue from operations, which is equal to opening inventory plus net purchases plus all direct expenses minus closing inventory. I hope you remember direct expenses. These are the expenses which were shown and reflected on the debit side of trading account. Example: wages, carriage inward, octroi, import duty, etc. So all the direct expenses are included in this formula of cost of revenue from operations. Once you arrive at cost of revenue from operations, this is taken in the numerator in the formula, and the denominator is average inventory. Now what is average inventory? Average inventory means opening inventory plus closing inventory divided by 2. Do you remember in trading account we used to show on the debit side the first item in trading account was to opening stock. So that opening stock is our opening inventory, and on the credit side of trading account we used to write buy closing stock after sales, and that is closing inventory. So if in your question you are given opening inventory and closing inventory separately, you need to add it and divide it by 2 to arrive at average inventory. Otherwise, if only inventory is given, then you have to take it directly in the formula. So that is about the first type of activity ratio, which is known as inventory turnover ratio. When you do the question using this formula, the answer will be represented with the suffix times. Suppose it comes 3, so you write 3 times. I hope you will note down all these important details. Now we move with the second category of activity ratios, which is known as trade receivables turnover ratio. What is trade receivables turnover ratio? So then first of all, let me tell you the word trade receivables, it includes debtors and bills receivable. I repeat, the two current asset debtors and bills receivable are together known as trade receivables. So let us see what this says. Trade receivables turnover ratio establishes the relationship between credit revenue from operations. This word credit is important here. Only when there is credit transaction we have debtors and bills receivable, because there is no debtors and bills receivable in case of cash transactions. So credit revenue from operations, in simple terms, net credit sales and average trade receivables. What is the formula for this ratio? Trade receivables turnover ratio is equal to credit revenue from operation, that is net credit sales, divided by average trade receivables. I told you what is trade receivable, and now we will see what is average trade receivables. Average trade receivables is equal to opening debtors plus opening bills receivables plus closing debtors plus closing bills receivable divided by 2. This is known as average trade receivables. So by applying this formula of trade receivable turnover ratio, when you arrive at answer, you will express it in times. One more thing, if in your question opening and closing is not separately given, then you will directly take the total of debtors and the bills receivable in the formula of average trade receivable. When you are taking debtors and bills receivable from question, do not divide it by 2. You will divide it by 2 only when you have separately the opening and closing. I hope this should be taken care of. The next category of activity ratio is called trade payables turnover ratio. As the name says, trade payables turnover ratio, trade payables include creditors and bills payable, just like we have in trade receivable debtors and bills receivable. In trade payables, we have to include creditors and bills payable. Trade payables turnover ratio establishes the relationship between net credit purchases and average trade payables. What is the formula for trade payables turnover ratio? The trade payables turnover ratio is equal to net credit purchases. Remember, only credit purchases minus purchases returns, which will be equal to net credit purchases, and that is divided by average trade payables. If in your question you have only credit purchases, you take only credit purchases. If in your question you have the total purchases, then you need to subtract the cash purchases out of the total purchase to arrive at net credit purchase. And yes, if you have purchases return, you need to subtract it, and then only you arrive at net credit purchases. Now, what is average trade receivable? I'm sorry, not trade receivable, it is average trade payable is equal to opening creditors plus opening bills payable plus closing creditors plus closing bills payable divided by 2. So when you have all these four separately given to you, that is opening creditors and closing creditors and opening bills payable and closing bills payable, in that time you will add these four together and divide it by 2 to arrive at average trade payables. Otherwise, if only creditors and bills payable is given, you just need to add them and put it in the formula here, average trade payables. So take care of this, and as I told you, when you calculate, you have to express it in times. So two, discussion of the formula is done, that is trade receivables turnover ratio and trade payables turnover ratio. Both relates to credit sales and credit purchases respectively, need to be taken care of. And the first category was inventory turnover ratio. Now we are moving with the fourth of activity ratio, which is working capital turnover ratio. This formula shows the relationship between working capital and revenue from operations. Revenue from operation means revenue earned by the company from its operating activities only. Children, this word operating is important. The revenue earned from operating activities of the business. So non-operating income should not be a part of this formula. Non-operating income means any income earned from the sale of fixed assets or your old assets sold. Those are your non-operating incomes that should not be included. So the formula of working capital turnover ratio is equal to revenue from operations divided by working capital. Revenue from operations is sales and working capital is equal to current assets minus current liabilities. This formula was also utilized while doing the liquidity ratios when we were doing current ratio and liquid ratio. Working capital formula was utilized during that time. So the same working capital here is current assets minus current liabilities. So these are the four categories of activity ratios: inventory turnover ratio, trade receivables turnover ratio, trade payables turnover ratio, and finally working capital turnover ratios. And all these ratios are expressed in times. You must revise this, note it down in copy, and then in our online class we will discuss the questions and practice it. So children, the last category of our ratios is known as profitability ratios. Profitability, as we all know, it refers to the financial performance of the business. That means how much profit a business has earned. The efficiency of any business is measured by its profitability. Accounting ratios, which measures the profitability, are known as profitability ratios. Very simple explanation of profitability ratios after doing the three categories. These ratios are expressed in percentage form. So whenever you will solve the questions related to profitability ratios, the final answer should carry a percentage sign. The important profitability ratios under this category comes as number 1, gross profit ratio, number 2, operating ratio, number 3, operating profit ratio, number 4, net profit ratio, and finally the fifth one, return on investment, or it is known as return on capital employed ratio. So we have seen what is profitability ratios. Let us move now with the first type of profitability ratios, which is known as gross profit ratio. Children, I know you all are familiar with this word gross profit. We have done trading account in class 11th and we have calculated gross profit by making trading account. So the gross profit ratio establishes relationship of gross profit and revenue from operations, that is net sales. This ratio is calculated and then finally shown or expressed in percentage form. The formula for gross profit ratio goes gross profit by revenue from operations multiplied by 100. So when we divide gross profit by revenue from operations, that is net sales, and multiplied by 100, we arrive at gross profit ratio. Now, gross profit ratio is equal to, I'm sorry, gross profit is equal to revenue from operations minus cost of revenue from operations. So what is revenue from operations? It is net sales. And what is cost of revenue from operations? It is cost of goods sold. So the difference of net sales over cost of goods sold gives you gross profit, which will be represented here in the formula of gross profit ratio. I hope this is clear. A plain and simple formula to remember. Now let's move with the second category of profitability ratios, which is known as operating ratio. So what is operating ratio? It establishes the relationship between operating costs and revenue from operations. Operating costs are those costs which are incurred for operating activities of the business. Remember, operating activities are the main revenue generating activities of the business. So only those costs or expenses are included which are related to operating activities of the business, which means non-operating expenses will not be a part of operating ratio. Now let us see what is operating cost. Operating cost in simple term is equal to cost of revenue from operations plus operating expenses. We already know cost of revenue from operations from previous formula, that is gross profit ratio. When you add operating expenses with cost of revenue from operations, it is equal to operating cost. We know cost of revenue. What we have to see is what are things included in operating expenses. So operating expenses include office expenses plus administrative expenses plus selling and distribution expenses and employee benefit expenses plus depreciation and amortization expenses. So all these expenses, when they are added to cost of revenue from operations, it is equal to operating cost, and operating ratio is equal to operating costs by revenue from operation multiplied by 100. We can replace this word operating cost with cost of revenue from operation plus operating expenses multiplied by 100 divided by revenue from operations. So that is all about operating ratios. Now, the third category of profitability ratios is known as operating profit ratio. So, you can see here operating profit ratio measures the relationship between operating profit and revenue from operations, that is net sales. What is operating profit ratio equal to? Operating profit divided by revenue from operations multiplied by 100. So what is the new here? New word is operating profit. Children, you remember operating profit? I'm so sorry. You remember gross profit, which we calculated in gross profit ratio, where we have subtracted cost of revenue from operation from revenue from operation. So that is gross profit. Then you add any other operating income and you subtract other operating expenses. You arrive at operating profit. Remember, in gross profit, we need to add operating incomes, if any, and subtract other operating expenses, which are mostly the indirect expenses reflected on the debit side of profit and loss account. Then you finally know revenue from operation is equal to cost of revenue from operation plus gross profit, which will be the denominator of your formula. So that is about operating profit ratio. The next formula under profitability ratio is net profit ratio. This word net profit is not new to you. You have calculated net profit by preparing profit and loss account in the chapter financial statement last year. So that net profit is utilized to calculate net profit ratio, which establishes the relationship between net profit and revenue from operations, that is net sales. So net profit ratio is equal to net profit after tax. Remember, after tax, not before tax, divided by revenue from operations multiplied by 100. So when you are taking net profit after tax, then it is quite simple thing to understand that you have to also deduct interest out of it. So net profit after interest and tax. So this is the formula, and when you have to calculate net profit, you have to take care that from gross profit you subtract all indirect expenses. You can see here net profit is equal to revenue from operations minus cost of revenue from operations. Children, you can replace this revenue from operations minus cost of revenue from operations from simple word gross profit. So this entire explanation is gross profit. Then you subtract operating expenses. Then you also subtract non-operating expenses, and if there is only any non-operating income, you need to add it to it and subtract tax, because we have to take the profit after tax. So this is the formula for net profit after tax. I hope this is clear. This ratio will also be expressed in percentage when you finally get the answer. And now we are coming to the last and the most important formula for the profitability ratios, known as return on investment. or it is called return on capital employed ratio. I'm sure you have done business studies, capital structure. You must be familiar with this word return on investment. Return on investment is a very important formula to assess the profitability of the business, where the proprietors have to see that what is the profit they are earning actually on the investment or the capital employed by them. So this formula says return on investment or return on capital employed shows the relationship of profit, that is before interest and tax, with capital employed. This ratio is computed by dividing net profit before interest, tax and dividend by capital employed. So the formula is return on investment is equal to net profit before interest, tax and dividend divided by capital employed multiplied by 100. Now we have just discussed what is net profit after interest and tax in the previous formula, net profit ratio. Here the difference is it will be net profit before interest, tax and dividend. Then what is capital employed? In simple words, capital employed is equal to debt plus equity. I hope you remember debt and equity from debt equity ratio. So when you add debt and equity together, it is called capital employed. Then here there is a list shown for capital employed when you have to do questions either with liability approach according to the information given in the question, or sometimes you have to use the asset approach according to the information given in the question. So this we will discuss in online class when we are doing the questions. So that is the final formula, which is return on capital employed, and that brings an end to our chapter accounting ratios with two classification covered today in this video, that is activity ratios and profitability ratios. So children, you have to note down the entire content in your copy, revise it from the book, and then with online classes, we will do the practice of questions which you have to do very sincerely to have command over this chapter accounting ratios. So do your work, revise it, learn it, and also put it into practice. Thank you. Have a very nice day ahead.